Welcome. Before starting, it is important to note that the information presented here is for informational and educational purposes only and does not constitute investment advice. Every investor should conduct their own research and analysis based on their financial situation, risk tolerance, and future expectations before making any investment decisions. Markets involve risk, and past performance does not guarantee future results. Workday reported solid financial results overall. Revenue increased by 14.5% year-over-year, and subscription revenue grew by 15%, which shows continued demand for its enterprise software services. Earnings per share exceeded analyst estimates, confirming operational strength. Despite these positive results, the stock declined by 9% following the earnings release. The main reason for this reaction was the company's guidance for 2026, which investors considered weak relative to expectations. This reaction is closely tied to valuation. The company currently has a price-to-earnings ratio of 50, which is considered expensive. The stock is now trading at $118. For the valuation to normalize to a P/E ratio of 24, the stock would need to fall to approximately $60 to $70, representing a potential additional decline of about 40%. This makes the current valuation difficult to justify in the short term. It remains a strong company fundamentally, but the high valuation combined with weaker forward guidance creates the possibility of continued stock price pressure in the near term. Mercado Libre also reported strong top-line growth. Revenue increased by 45% year-over-year, exceeding analyst expectations and confirming strong expansion across its ecosystem. Net income declined by 12.5%, while earnings per share reached $11. The platform reached 83 million active buyers, which reflects continued growth in user adoption. For companies operating in expansion mode, revenue growth is often more important than net income, especially while they are still strengthening their competitive position. However, certain strategic decisions negatively impacted investor sentiment. The company began offering free shipping, similar to the model used by Amazon. This decision increases competitiveness and improves customer experience, but puts pressure on profit margins because the company absorbs shipping costs. In addition, the company expanded its credit card offerings to encourage higher spending on its platform, which can also reduce margins in the short term. Following the earnings release, the stock declined by 6%. The current price-to-earnings ratio is 46, which is considered high, especially given the decline in net income. The valuation remains expensive, but the strong double-digit revenue growth confirms that the business continues to expand at a high rate. The combination of strong revenue growth and profit margin pressure creates uncertainty about short-term profitability, but maintains strong long-term growth potential. Walmart presents a valuation concern despite its stability as a large-cap company. The stock had increased significantly, and valuation levels became less attractive relative to growth expectations. This valuation expansion makes future upside more limited compared to other large-cap technology companies with stronger growth profiles. Microsoft, Amazon, Meta, Visa, and Google remain dominant large-cap companies with strong market positions, diversified revenue streams, and significant influence across multiple sectors of the global economy. These companies benefit from scale, strong balance sheets, and continued investment in high-growth areas such as cloud computing, digital advertising, artificial intelligence, and global payments. Their size and market leadership position them as key drivers of the U.S. stock market and important components of large-cap portfolios. Overall, recent earnings reports highlight an important market dynamic. Strong revenue growth does not always result in positive stock price reactions, especially when valuation levels are high or forward guidance disappoints investor expectations. Valuation remains one of the most critical factors influencing stock performance, especially in the current market environment, where investors are more sensitive to future growth expectations and profitability trends. Subscribe to the channel to receive all the latest updates on the U.S. stock market and stay informed about important developments and opportunities.